Welcome to the Swisspreneur Show, a podcast about startup stories and hands-on learnings from experienced entrepreneurs. My name is Sylvan and I will be your host. We're back in Zurich and have a chat about how to successfully exit your company with serial entrepreneur Marc Bernegger. He already created 2 successful exits, and today we are going to talk about the process of how to get to this stage. We also talk about strategies of exiting and successfully selling your company. Make sure to check out the additional content of today's episode on our Facebook and Instagram profiles. Before we get started with the episode, I would like to introduce you to SBB Startup. If you think that your company is a good fit for the Swiss Railways, get in touch with them or learn more about their startup programs at sbbstartup.com. Marc, welcome back to Swisspreneur. It's great to have you again.
Yes, pleasure.
Today we're going to talk about the topic of the exit. When you actually exit your own company, there are several ways to do that. And I would like to start with the first question right away. What mistakes do you see Swiss startups making over and over again when it comes to the topic of the exit?
Yeah, I would say Swiss startups are not really reaching their potential at the exit because they mostly just talk to Swiss buyers. Mm-hmm. The traditional ones are the publishing houses, and we just have a few ones, so I don't have to mention them. Instead of really expanding and broadening the potential lead list. I mean, ideally, that's also a big mistake, perhaps not at the exit, but already before, that you normally also just talk to Swiss investors instead of flying to Berlin, London, Paris, wherever, and also involve international VCs and other shareholders from abroad, which automatically also broadens up the lead list or the potential list of buyers at the end. Because ultimately, if you want to succeed and get a nice exit, you should talk to as many potential buyers as possible. Either you do it yourself or you have an M&A boutique, and that's perhaps also something which sometimes is missing because there are not that many substantial exits, at least in the tech space, in the web space in Switzerland, that taking support from abroad, not from abroad, from external support is also very helpful.
Mm-hmm. You mentioned the internationalization when it comes to investors, but also to buyers. When would be a good timing to get that started? Is that something that you should already focus early on, like from the beginning, sort of be global from day one on? Or is there a certain sort of milestone that you should achieve first before you should actually look abroad for investors and exit partners?
Yeah, I mean, ultimately, it really depends on your business case and your vision, ambition, your plan, your markets you're targeting. But I think the earlier you have a broad shareholder base, the better. In our case, for example, at Amiando, we had business angels from day one from all relevant markets in Europe, Spain, UK, France, Germany. So that was part of the whole strategy, that we knew that if we go not global at the beginning, but at least if we expand to other countries in Europe, we always have a shareholder which can open doors. So, and the same I would say with industries. If you're in a market where you target different industries, it definitely helps if you have one representative in your shareholder base, which is also connected there and has some network and background there. So personally, I think, I mean, it's not about having as many shareholders as possible, but to broaden it up from the early days definitely helps. I mean, if you do a pure Swissing, that's also fine. But depending, as I said, on your case, if you have a certain international ambition, you should also have it reflected in your shareholder base.
Mm-hmm. I think you touched 2 very important points. One is the geographical spread of the investors that you work with, that they come from several different countries. In your case, with Amiando, they came from within Europe, but also that they are smart money and can open doors to potential buyers. How do you get to that point? What do you have to do, and at what stage do you have to be to get that right?
Yeah, also depends a little bit on your business case. I mean, and your network mainly. I mean, you have these traditional high risk takers which are only investing in the idea and the team. So that's really the very early stage, like the seed investors. Then you have far more which are at least looking for a working prototype. And then at the later stage, you have the ones who want to see some first customers and ideally some revenues. So depending on the stage you're normally targeting a little bit different investors. I think nowadays what's definitely far different than back in the times when I did fundraising, that you can raise a lot of money without touching any traditional venture capitalists or other institutional funds. That changed really completely. We have, especially in Switzerland, a lot of very wealthy and also very entrepreneurial thinking family offices and other non-institutional investors, which are especially focusing on startups. So that's all about connections and knowing the right people, but that's definitely also a very interesting source you can approach. Especially, it's far more relaxed, meaning less terms, less contract working, less lawyers. Because most of the funds, even if they're founded or the GPs are founders themselves, are also depending on their own investors. So it's a little bit a different game, right?
Absolutely.
And I mean, knowing how it is as a founder to have venture capital funds in a company, it's changing the mindset. I mean, you give away a lot of entrepreneurial freedom in exchange for the money, which is also understandable because the venture capitalist needs some controlling functions. He has to know what's happening. He has to have some influence and power to change something if it's going into the wrong direction. On the other side, as an entrepreneur, you normally want to be as independent as possible. I mean, when you look what Google and Facebook did even after their IPO, that shows a little bit the other extreme, that individuals sometimes even have more power than the majority of the shareholders. So that's the other extreme. But ideally, as from a founder perspective, you want to be as independent as possible, and that's why most of the traditional institutional money is perhaps not the ideal match, especially in the early days.
Mm-hmm. How did you maintain this entrepreneurial freedom or flexibility at Amiando with your 6 co-founders?
Yeah, as long as the numbers are going into the right direction, you're always very, very flexible and you keep your freedom, and that can change quite dramatically on the other side. I mean, it definitely helps if you have a certain diversity in the shareholder base, what I said in the beginning. If you're relying on one single institutional shareholder, which is knowing the game, giving you perhaps in a down round very bad conditions because you were not able to attract additional investors in the better market conditions, that's definitely something which is very bad for the founders. So having also a diversified a group of shareholders, sometimes perhaps even not having the same opinion. So it's not just bad VCs versus founders. It's also perhaps some VCs have different opinions. That can help. It can also make it far more complex. Mm-hmm. So that's why, as I said, keep the entrepreneurial mindset. So that could even mean that you don't take the best term sheet with the highest valuation, but the one with the most entrepreneurial investor behind. Mm-hmm.
When you started usgang.ch and Amiando, was the exit always your main motivation behind it? And what is your motivation behind the crypto finance group that you set up afterwards?
I mean, at usgang.ch, as we talked about in the first episode, there was absolutely no master plan behind. We didn't even have a business plan. So for us, venture capital exit were terms we didn't really know. We just wanted to create a company and earn money with it and build a substantial structure. At Amiando, it was different because everybody had some experience as well and also some exits. there was a clear exit-driven strategy. So the whole case, that's why we took investors on board from day one, was set up to somehow at the right stage sell the company. And I mean, at all other projects I'm doing right now, where I invest money personally and time, there's always a certain exit oriented approach, because that's the only way where you can get a return. Sometimes it's interesting to see that founders build a company, then they sell it, get a lot of money, and don't know what to do, so they create another company instead of perhaps just keeping and continuing what they already did. So this exit-drivenness is something which I think sometimes doesn't really make sense. And you see more and more cases which are very profitable, so you can pay out a nice dividend. So why selling a stake of a highly profitable company to, in a normal case, start again from zero without knowing how it's evolving? Sure. So that's why I think it's really depending on your underlying business. But in general, I mean, there's always a certain exit focus. I mean, that's a little bit how the whole private equity venture capital industry is based on.
Mm-hmm. Now you described the different approaches with usgang.ch and with Amiando. Do you have a personal preference for which setup you prefer? Sort of having this passion and just sort of acting out of this passion, don't really think about what could happen afterwards, or having this very specific plan to actually strive for an exit and also getting investors on board very early on?
I mean, as a founder, I think the first one is far more appealing. As an investor, I don't know if you're always lucky and happy when you have no clear roadmap and exit-oriented focus. Mm-hmm. But I think from a founder perspective, the first approach is definitely far more appealing, because you really focus on the daily underlying business and not about the share price, right? So it's definitely a different culture, right? And honestly, if I meet founders and they talk more about the increase of the share price and the potential exit and the market size, which is a big part of the evaluation, and less about why they do something, what they want to solve, why they're driven and passionate to do this, I lose a little bit interest, because normally, if you do something successful and passionate and the elements around it are the right ones, as a side effect, it's also a successful business, which is interesting to invest in. But if you come from the other side and the passion and ultimate drivers of the founders is missing, I think it's not really a very appealing case to invest.
You're also an investor yourself. You invested in several companies. And usually as soon as entrepreneurs get investors on board, these investors expect a certain return, maybe not tomorrow, but at a certain point in time. How do you deal with that as an entrepreneur, and what are the different ways how to satisfy this sort of hunger for return from an investor? An exit can be one of them, but there are also other ways.
Yeah, also depending on your underlying business. I mean, in the tech space, it's mainly the exit, right? But there are, for example, in asset management, you can have very interesting, very profitable businesses, and you don't have to sell it, because you just get, after a certain time, a nice return every year. So that's also a little bit depending on your shareholders. I mean, if you have very aggressive venture capital funds which need a 30x in 5 years from their investment, you definitely have a different strategy than a family office, which is far more relaxed and is in for a 10-year plus time frame. So I think ultimately you shouldn't follow the investors. You should select the investors based on your own preference, right? So it's clearly aligned, and you don't create an artificial business case and artificial numbers just to fulfill the requirements of your shareholders.
That will probably be the wrong incentivization.
Normally that's not working out, right?
You also have been involved in an IPO last year in 2018, and you've done 2 exits yourself with a trade sale in both cases. which case do you prefer, if there's any preference from your side?
Yeah, I mean, I had different hats on, right? I mean, Amiando and usgang.ch, I was one of the co-founders, so I was in this role at Amiando with Next Generation Finance Invest. We were the main shareholder, and I was one of the partners of this shareholder. So it's a purely investor role. So these are a little bit two different approaches. I think from a founder perspective, it's always a little bit artificial idea that you think that you sell your company and then you get money and you just move out. I mean, in reality, you normally have a certain lockup period, and you're still committed for sometimes up to 3 or 4 years. So you still continue after the exit to work for your company or for the new buyer. So this whole separation from a company is normally not like a clean cut. It's more like fading out.
How was that in your case? Because you described that you left Amiando pretty soon after the sale. Right?
Yeah, right. I mean, I was out of the business when we sold the shares, which for me was what I wanted to do, because as we already talked about, I moved to Munich for this company, and my regular life was always in Switzerland. I had my girlfriend, nowadays wife, in Zurich, so for me, I wanted to go back to Switzerland, so I was not really interested in any retainer afterwards. So I had a very clean cut and could immediately start something new and focus on new things.
Mm-hmm. But that also means that you left some money on the table, right?
Yeah, but that's naturally part of it. I mean, my co-founders, they got some nice retainer and some regular salary, but also left a little bit earlier than originally expected. So at the end, it's always a little bit about your ambition, if you function, or you can perhaps even grow. I mean, I know also cases where the founders had an even better time after the exit because they could evolve into a bigger company and had sometimes a better role in a corporate setup. So I think that's a very individual question. But for me personally, I already had some ideas and wanted to move into the fintech space right afterwards. So that was a perfect setup. And with still 4 founders continuing to work after the exit for Xing, I think that's also for the buyer a nice setup, because normally you don't have that many founders. So it's I think nobody was really missing me. I had my roles were already organized by people stepping up, so that was completely well organized. Mm-hmm. And that's why I think it's very individual. But as I said, normally you have an earnout, you have a vesting. Yeah, you have people working years after they sold the company and still doing their job even after they gave away the shares. And at an IPO, the good thing is that you have immediate liquidity, right? So you can keep some of your shares and follow the company, even perhaps you left it completely. So that's definitely one of the advantages at an IPO, that there's not normally one shareholder taking off all the shares from the table, but you can be still involved, right? Mm-hmm.
Maybe you can walk us through, if you're open to sharing these numbers and or giving us a range. I think our listeners would also be very interested in hearing more about what such an exit as you had it with Amiando in the 10 million euro range. What does that actually mean to the founders? Would you be open to share some ranges or numbers, what that meant for you personally, and mm-hmm. what that could mean for someone who sticks through the whole earnout investing plan, approximately?
Yeah, it's also a very individual question. I mean, ultimately, I'm sometimes surprised when I see how small the shareholdings are, when you see some of these big exits at the moment, and you see that founders sometimes just have 1 or 2% left. Mm-hmm. So because they had so aggressive growth ambitions and raised a lot of money at still high, but ultimately not as high valuations as if they would have done it perhaps in a more sustainable way. So you have a lot of the shares going to the institutional investors, and just a small part is still owned by the original employees and founders. So that's something. I mean, for example, at Amiando, the founders still had the majority of the shares. So that's already a certain indication that you were still able to control the company, and it was not just a purely financial driven case where you had a few so-called founders without any shares left, right? Which also is a big trigger after the exit, because if you have just a few shares left, the earnout becomes far more relevant. So sometimes even the salary is a relevant discussion. But if you still have a substantial stake, I mean, to just, as I said, give you the indication of a founding team having more than the majority of the shares at the exit, it's just a completely different game, right?
Absolutely.
So that's why, but I think there's no general average rule. I mean, I think today it's not that often that you see, at least in the aggressive high growth space, founders still owning more than 50% of a company. So normally it's more like in the very low two-digit area, sometimes even less. And then the metrics are quite straightforward, right? And that's why, I mean, people are also, I think, sometimes a little bit surprised that if you read there's a 200 million exit and you had 4 founders, that people think now they have all the money they need. But yeah, you don't have to be a mathematician to do the math that if you have just 10% left divided by 4, that it's still some money, but it's not that you don't have to work anymore. So that's why that's also something I think founders should really keep in mind, that the valuation is one thing, but ultimately it's always just the share price and the number of shares you have. So instead of just raising a lot of money, it could also sometimes make sense just to spend it very cautiously and then raise money when you really need it. Because also from an exit perspective, I mean, at the end you just get what you still have. And also VCs know how to play the game. So sometimes they make a huge round right before an exit. So they get some additional shares with money nobody really needs at the end. So that's why this whole game is a little bit a known skill set you have to know, right?
Did you pay special attention to keeping your shares above the majority?
I mean, ultimately, I think every founder is always interested in giving away as less shares as possible. I mean, in our case, we had roughly 20 employees, which also had shares, so to incentivize also the people. I think that's always a big trigger. I mean, we had 2 people, they left quite right after the exit because they didn't have any earnout element. They made some money and now they were also free to do whatever they wanted. So that's definitely one part. And as I said, I mean, normally as an investor, you want to have your founders with enough skin in the game. So as soon as they fall under a certain level and you realize that perhaps salary is becoming more relevant than this value of the shares, I mean, that shouldn't be the way how to incentivize your people. I mean, ideally, the founders of a company you invest get insanely rich and you as a shareholder are part of this success, right? So I think it's not about taking away the upside from the founders. It's more that you cautiously think about valuation and how aggressively we want to raise money.
Absolutely. Now comparing the IPO that he did last year to the exits that he had before that, what do you think, which exit scenario makes sense at what time? Or of course that also depends on the business model, but in general, if you had to sort of summarize that, when would you say makes an IPO sense and when does a regular exit in sort of a trade sale make sense?
Yeah, I mean, in general, IPOs, they just makes sense at a certain level, right? I mean, I would say if you don't have a valuation of at least 200 whatever million, I think, I mean, you can always do an IPO, but then you're just literally too small to be listed. I mean, if you want to do it at the serious market, serious exchange. So that's already a first trigger. I mean, if you don't have a company which has a valuation like that, it's difficult. Then additionally, I think it's far more difficult nowadays to do an IPO if you're not profitable. So having a valuation like that and be profitable already shows a little bit that it has to be a real serious business, right? And also from a business case perspective, I mean, if you do a trade sale in a fast-moving and growing tech company, you could be the perfect addition for a big buyer, but the underlying company perhaps never gets profitable. That's okay because you have better technology, or the buyer can do something with your whole company and by that enabling the value. If you do an IPO and you don't have a sustainable long-term path into profitability, I mean, that's not going to work, right? So I think for an IPO, you really have to have a sustainable long-term plan. Ideally, you're already profitable and it's now about scaling to the next level. I mean, you're visible, all your numbers are public, people are analyzing you, all the activities are visible. So that's why it's definitely a completely different story. And unfortunately, I mean, we hardly have any examples in Switzerland of listed tech companies.
What do you think? Why is that the case? Because we're just too small company-wise?
Yeah, we don't have relevant companies. I mean, we have relevant companies, but not as relevant to be listed. I mean, we don't have a Delivery Hero at Zalando or some of the other European listed tech companies. And that's a pity, but that's just a fact. And I mean, that's definitely something which would help. I mean, we have a few very successful traditional software companies like Dynamos, Avaloq, and Leontech in the fintech field, but these are perhaps different models than the ones we are looking for when we see what's happening in Berlin, London, or other tech hotspots in Europe.
Do you think that this should change in Switzerland and that we should strive for development towards this London or Berlin startup ecosystem?
Yeah, I mean, the more ambitious, the better. But to reach this ambition, as we also discussed, I think you have to go out of Switzerland. I mean, you can start here, you can have your base here, you can have your smart people here. But I mean, you have to go to bigger, more attractive, more scalable markets, right?
Sure.
I mean, Zalando is not listed because they're very successful in Switzerland. They're very successful here, but I mean, it's just a small portion of the revenues, right?
Absolutely.
That's why having Switzerland as a base and attacking all the big markets in Europe, that's at least in the retail space, that should be the approach.
We also talked about timing in the first episode, and you mentioned that if you had waited a bit longer, because the whole event space was sort of just taking off after you actually sold your company Amiando to Xing, you might have probably had a bigger exit. When do you think does it make sense to actually sell a company or to strive for an exit?
Yeah, I mean, one side is the business side, the other side is the sentiment or the setup of the company itself. I mean, as I said, for us as founders, it was a perfect opportunity in this specific case. At the end, it's also a little bit about how your roadmap and ambition is based. I mean, if you have a successful company, you get acquisition offers all the time. Now, the shareholders, mainly driven by the founders, have to decide when they want to sell and what's the ultimate trigger. Do they just want to get as much money as possible in a very short time? Or do they believe that they're just at the beginning of something very big? I mean, I remember when Facebook got this got this offer to sell it for, I think, 1 billion and then another one for 3 billion, and everybody thought they're crazy that they're not selling. And I think personally I also thought that's already a very ambitious price, and they were in the very early days. Now they have a 3-digit billion valuation and still a lot of potential, I think. So it's always easy looking back. So at the end, it's mainly driven by the ambition of the shareholders and the founders, right?
What role does this ambition by the founders exactly play? Like, I can imagine that if you work in your own company very, very hard for a certain time, that maybe after 4 or 5 years, you also get a bit tired. And then if there's a not great offering to buy your company, but an acceptable one, that you sort of think, okay, let's just do it. What role does that play, and have you any personal experience with that?
Yeah, I mean, it's definitely a little bit the question of the personality of the founders, right? I mean, all the famous tech founders, they wouldn't have to have their full day working day anymore, and they already have far more money they could spend, but they're still fully involved and passionate and driven. So I think at the end, it's also a little bit what you want to do in your life, right? I mean, I am personally somebody who always wants to do, after a certain time, something new. And other ones, they have perhaps found their passion already in the early days, and they don't see any limitation. The sky is the limit, and they just want to follow the path and stay in their company for 20 years or even longer. So I think that's always a little bit depending on ultimately on the desires of the founders, right? I think it's also a little bit depending on your non-business related activities. I mean, I have 2 little kids, so I really enjoy the time and a far better work-life balance than a few years ago when I had my own companies, that I can really also do a lot of things which have absolutely nothing to do with business. And I also think it's far more rewarding after having a family to see what's happening outside the pure business world. If you don't have this and know this, you don't realize that. And if you have it and you don't like it, you perhaps focus on your business again. But I think that's also something different. I mean, if you have a founder with a family, it's a completely different setup than a 20-year-old something, which is fully available, flexible, location-wise, time-wise. So also based on that, I think you have a little bit a different attitude to your ambition and how would you structure your daily business life.
You also mentioned the requirements to do an IPO exit with 200 million plus valuation and a good long-term strategy for a profitable business model. How would you describe the requirements for a trade sale exit? What are the key factors that you should control there, or how do you make sure that you get towards a successful exit in that trade sale area?
Yeah, I would say it's also extremely individual. I mean, you have companies, they are acquired a few months after they started. I remember in my time, StudiVZ after 11 months with close to 0 revenue, but everybody just wanted to get exposure into this space. So I think they had a 85 million exit after 11 months, which is quite unique, but quite crazy. Or also with Instagram and other platforms. I mean, with 16 employees, a billion exit and stuff like that. I mean, these are all outliers, but that's something which can happen if you just have the right product with the right potential buyer in the right time frame. On the other side, I mean, normally you have to show that you have a sustainable business, at least one which is has potential to grow, and together with the potential buyer, you can even grow faster and put something on the bottom line of this company. So personally, I mean, but that's a very rough definition. For me, I always say if you have 6-digit revenues a month, it's becoming a business. Before, it's more like you still try to find out what you want to do. And then I would say at the level of 10 million plus, it's a little bit like in a traditional definition an SME, right? And at this stage you will always find buyers, because then you have achieved something which is also financially tangible.
10 million annual revenue, right?
I would say that's a very rough number, right? Because, I mean, normally you want to get acquired by a player who is looking for tech-related companies, so it's not another SME, it has to be something bigger.
Sure.
So that's a little bit like one of the milestones I see. So the 6-digit revenue to prove per month, to prove that it's a business, and then let's say the 7-digit one to prove that it's something which is really a long-term business. And then depending on your funding strategy, I mean, it's a little bit different to reach a revenue of 1 million per month organically without any external funding, or if you raise 200 million. I mean, that's also something people sometimes forget. If you see some of these numbers nowadays and you don't put it into perspective what they raised to reach these numbers, it's also sometimes a little bit a different game, right? I mean, if you spend 100 million, it's not that difficult to get revenues of 10 million. You still lost 90 million, right? So that's why I think that's a little bit like one of the indications. Also, when you look from a purely market-driven perspective with all these M&A boutiques and other corporate finance and investment banking players, I mean, they normally say we need a transaction size of at least 20 to 30 million. So that's perhaps another angle, that you at least have to have a valuation and an underlying business which reflects the valuation of that, because at this size you already have an existing M&A corporate finance market.
And then once you get into this area of regarding the numbers, then an actual M&A process can start. Can you walk us through how that happened at Amiando? Because you were there as a co-founder. You sort of had the first row seat.
Yeah, I mean, ultimately that was a little bit different there, because as I said, Xing was one of our most relevant clients, and there was also some connection between the founders and the team. So it was a little bit a special situation. But I would say in general, I mean, it's all about supply and demand, right? I mean, also selling a company or a trade sale of a company is supply and demand. On the one side, you have founders, people who are willing to sell something, in this case a company. And on the other side, you have somebody who's looking to buy something for several reasons, and you have to match this. And now the question is, as a founder, do you have the resources to really find all the right potential buyers, or couldn't it make sense to involve other ones which are supporting you? Because something people forget, I mean, that's the same with financing rounds. You normally have to invest so many resources, including the ones from the founders, to do a proper funding round, and especially a proper exit trade sale or IPO process, that it really also slows down a little bit the other activities. So I would say at a certain level, it definitely makes sense to involve external parties which are supporting you in this field, right?
Absolutely.
And I think people would be surprised that quite a few of the big exits, I mean, normally you don't read about it, but are also supported by intermediaries, because they ultimately guide you and support you on both sides. So as you have the lawyers on one level, you have the corporate finance people on the other level, and they ultimately go through all the details, because as a fully operational founder, you normally have also your daily business to take care of, right?
Just to go a bit deeper on this process, like after you have this first contacts and there's maybe a mutual interest in going deeper about the whole acquisition and exit topic, how does that process look like? Like you first sign an LOI or an NDA, and then you probably go deeper and deeper to the due diligence and price negotiations. Yeah. Can you walk us through this process in terms of steps and also in terms of duration, because such a sale as it happened with Amiando, for example, but probably also with usgang.ch, is not happening overnight.
No, and it's also very individual again, but I mean, after the NDA and LOE, normally you can share far more information, right? And as a tech company, normally you have a big part of it is the tech due diligence, because that's part of the assets the buyer is acquiring. Depending on the buyer, you sometimes also do a people due diligence, because you want to know, because you buy in the whole team, right? Mm-hmm. So what's the background? Are they fitting into the existing culture of the buyer? Then you go into all the numbers. I mean, just because on an Excel sheet you have some numbers, it doesn't always mean that these numbers are also exactly right. Exactly. So you have to verify all your original theses. Mm-hmm. And then, and that's always a little bit the tricky part, because you share everything, but on the other hand, you don't know if you really push it to the finishing line, right? You have to find, ultimately negotiate the terms. I would say nowadays it's quite common that you implement a lot of KPI-based elements. So it's not that often the case anymore that you just have a number and that's it, but you have some success-driven elements. So after the acquisition, you define certain targets, and if you reach them or overachieve them, you get some additional incentives. And if you completely fail, the price of the acquisition is lower. Mm-hmm. It's getting very complex when you have a listed company, because there everything has to be public, right? So literally you have to announce all the terms, so the investors and shareholders know what the conditions of the acquisition are. Mm-hmm. I mean, in our case, when the announcement went out that Xing is buying Amiando, the stock price of Xing went up quite dramatically. So I think they even could refinance with the increase of the value of the company on the paper. At least they could refinance the whole acquisition. So let's say the market said that it was a very good price, and yeah, that's a little bit the structure, right? And I mean, in general, it's also a lot about people. I mean, if you have on the buy side and on the sell side people, and it's not matching, I think it's very difficult to finish a process like that, because on the one side you have to work for somebody, you have different shareholders and owners afterwards. On the other side, you buy into people, and I mean, you can kick out everybody afterwards, but normally it's part of the asset that you have smart people who build something, and that's why you buy into it. So I think you have the hard facts and the numbers and everything which is somehow black or white, and then you have also the human side, which is definitely also a big part of it, right?
And how long did the overall exit process take you at Amiando? How many months?
Yeah, that's very difficult to say, because we already had discussions with Xing in the very early days. I mean, the founder of Xing reached out to us when we literally just started the business, not because he just wanted to buy us, but he said that's something they need and he wants to have us somehow involved. Okay. So literally the first contact till the exit was 4 years in between. Yeah. And that's why we always had a constant discussion, and we shared some information, and we knew that there's always a certain natural match. But I think in general, I mean, also depending on the size and the complexity of a deal, I would say a 3 to 6 months period is definitely quite normal. Mm-hmm. I mean, if you do an IPO, it's a different game. It even takes longer. I mean, especially from the internal decision process till you really are listed. But that's a little bit the time frame, right? Okay. I mean, there are also in some extreme outlier events some very quick activities, because I mean, ultimately it's quite straightforward. You have shares and the price per share, and if somebody convinces all the shareholders to get money for shares, you can literally close a deal at the table in a few minutes. But I think in reality, you have a little more questions to solve than just the share price. So that's why Yeah, it's a very complex process, and also very emotional, right? Because normally, especially when you, I mean, I remember when I put the signature on the share purchasing agreement of in a law office here in Zurich when Springer acquired usgang.ch, and you knew that this signature, I mean, there were a few ones, but these signatures are ultimately the last step of something you built up from scratch with 3,000 francs and a close friend from school for close to 10 years, 9 years, right? So, and at the end, it's just a signature. I mean, in exchange, you get some money and give the shares, but the ultimate last signature is a little bit like the end of your role as a, I mean, you're still the founder, but yeah, the role changes, right? So that's definitely quite a unique experience. And I mean, differently to financing rounds where the signature just gets money into the company normally for the next step, it's definitely a little bit like a more intense act because it's like the beginning of something new, but it's also the end of something. So yeah, it would be interesting to ask other people how they felt when they put the ultimate signature on a contract which sold their shares of their own company, right?
Absolutely. We'll have some more successful Swiss exits that we will cover in the interview, so we can ask them this question. I think this is also a very nice ending point with the end of a chapter and starting something new. We also come to the end of this episode. Is there anything that you would like to add that we have not talked about yet regarding the exit?
Yeah, I always say, I mean, the exit is definitely often the ambition and ultimate plan of an entrepreneur, but I think it should evolve out of your other activities. So if you always look into the exit and forget to really run and build something sustainable and successful, you have the wrong focus. So I think the exit should be something which comes as a side element of your entrepreneurial activities, but it shouldn't be the driver, and especially it shouldn't be the ultimate reason why you do something, because then you lose a little bit the focus on the real relevant stuff. So it's a very important part of a life cycle of a company, and also a very unique experience. But I think you shouldn't focus too much on the exit.
Awesome. I think that's a very nice sentence to end the conversation. Thank you so much, Marc, for taking the time to have a chat with us today.
Thank you.
Thank you very much for listening to today's episode. We hope you liked the content, and if you did, please rate us on Apple Podcast. We would highly appreciate that. Next week, we'll already be back with a new episode, a Q&A session. Check out our social media channels for handing in your questions to the topic that we will discuss next week and get them answered by top experts out of our network. If you have a burning question, that's the time to ask it and get it answered from professionals. So we hope to see you again next week for an all-new Swisspreneur episode.